Hey everyone, welcome to The Explainer. I am absolutely pumped to dive into this one with you today because, well, we are tracking a genuinely historic hyperchromatic surge in the markets right now. We're talking about the semiconductor sector's explosive parabolic rally. It's a move so massive and so incredibly fast that it's literally leaving veteran traders completely stunned. So today, we're going to visually unpack the data, look at the fundamental drivers underneath it all, and ask the trillion-dollar question. Are we witnessing a dangerous market bubble, or is this the blueprint for a totally new economic era? Let's get right into it. Just take a look at this pulsing, vibrant gold heat map we've got here. That right there captures a staggering 40% surge. Since hitting a recent low back on March 31st, the Philadelphia Semiconductor Index, which we all know as the SOX, has absolutely skyrocketed. This heat map captures the sheer parabolic energy of the market right now. Every single glowing sector you see contributed to this massive move, making it hands down the absolute best performance we've seen in this index since the year 2000. And it wasn't just how high it went, it was how totally relentless the climb was. 18. That's the number of consecutive days this index closed in the green, a record-breaking 18-day winning streak. Just to put that into perspective for you, in the entire 32-year history of the SOX index, the previous records were just 10 or 11 days, and that was way back in 2016 and 2017. This kind of vertical ascent, it firmly cements this run as a true historical anomaly. Now, a massive catalyst for all this momentum was what analysts are now dubbing the Tuesday resurgence. As geopolitical tensions in the Middle East started to cool off, capital just flooded right back into the market. Imagine these 3D particle flows, right? They start as this chaotic, dispersed capital representing all that market fear and uncertainty. But then, right in the center, they consolidate into this massive, highly coordinated V-shape. It brilliantly illustrates that transition from chaos to a coordinated market recovery, showing this massive rotation of capital directly back into high-growth tech and semiconductor names. All right, moving on to Anatomy of the Surge, unpacking the $2.4 trillion boom. So unlike some of the pure speculation-driven rallies we've seen in the past, this surge actually has deep fundamental roots, all driven by the AI supercycle. Look at the heavyweights. Microsoft, Google, Amazon, Meta, they're on track to spend a combined $660 billion this year alone on AI. But here's the catch. It's not just GPUs anymore. We are seeing a huge bottleneck in high-performance memory, specifically HBM and NAND, which has sent stocks like Micron absolutely soaring. Add in Broadcom's wild $73 billion AI chip backlog and Intel's new custom terafab chips being built for heavy hitters like Tesla and SpaceX, and you've basically got a perfect storm of demand. But here is a crucial point. The buyer base has fundamentally expanded. It's no longer just big tech companies buying up all the chips. We are witnessing the rise of sovereign AI. Nation-states across Europe, Asia, and North America are aggressively securing their own AI compute capacity and domestic semiconductor manufacturing. And why does that matter to us? Because treating silicon as a matter of national security creates a permanent demand floor. It actually provides a massive buffer against the traditional boom and bust cycles that have, frankly, always plagued the semiconductor industry. Which naturally brings us to dot-com bubble 2.0, historical echoes of the year 2000. Let's actually look at the stark data side by side. This comparison table shows exactly how overextended the market has become. Those 18 consecutive up days absolutely shatter the 2017 record. The roughly 41% four-week performance, we haven't seen anything match that since March of 2000. And perhaps the most alarming stat for technical analysts out there, the index recently traded 48% above its 200-day moving average. That represents an extreme overbought condition that we quite literally have not seen since the peak euphoria of June 2000. But, what's really interesting is the other side of that coin. Yes, the index is up a historic 137% year over year right now, which is massive. But if we look back at the actual peak in March 2000, the index was up an unbelievable 228% year over year. Plus, technical analysts are pointing out that right now, there really isn't any major bearish divergence on the long-term charts. So while momentum is incredibly hot, maybe dangerously hot, the data suggests it hasn't quite reached the lethal terminal extremes of the 2000 bubble bursting. At least, not yet. Okay, let's pivot and look under the hood. Hidden market risks. Cracks beneath the surface. The primary concern bubbling up right now is that the internal leadership structure of this rally is completely shifting. Look at this comparison here. On one side, second-tier AI concept stocks and these highly volatile names are experiencing staggering, massive surges. We're talking companies like CRDO up 95%, MXL up 92%. But on the flip side, the undisputed AI general, nvidia, is severely lagging. It was only up about 15% during this exact same period, actually underperforming the broader semiconductor index by 18 points. The financial blog Zero Hedge analyzed this exact divergence, and their conclusion is pretty stark. They wrote, when the generals stop leading and the market starts chasing everything, trades are often closer to exhaustion than expansion. The argument here is that this is no longer a fundamentally driven expansion led by the mega-cap giants, but rather it's turning into a late-cycle liquidity-driven chasing game. And that's exactly when good trades rapidly become very dangerous, crowded trades. And honestly, it's not just the chip stocks acting strangely. We're seeing the small-cap Russell 2000 vastly outperforming the tech-heavy NASDAQ 100, which points to a pervasive rotation of capital into lower-quality names. At the exact same time, the VIX, the market's main fear gauge, is actually rising alongside stock prices. This rare spot-up, vol-up dynamic is making the cost of hedging your portfolio prohibitively expensive right now. So we really have to ask ourselves, is this a healthy broadening of the broader market, or is it a classic late-cycle warning siren? Let's look ahead. Outlook for the second half of 2026, preparing for the next phase. We've mapped out the critical upcoming catalysts you absolutely need to keep on your radar. First up, the high-stakes Trump Z Summit in late March. Whatever happens there could entirely rewrite the rules on semiconductor export policies. Next is NVIDIA's GTC 2026 conference, where the market is fully expecting the big reveal on their next-generation Vera Rubin architecture. And finally, the massive sector-wide shift expected in the second half of the year, the move away from simply training AI models and towards agentic AI. That means actually deploying autonomous AI agents into the real world, which requires vastly different inference chips and infrastructure. We have covered a tremendous amount of ground today, from 18-day record streaks to those hidden market cracks right beneath the surface. As you look out at the second half of 2026, I want to leave you with this final, really provocative question to think about. As we push the very boundaries of the digital economy, is this a genuinely new AI paradigm backed up by sovereign demand? Or are we stepping right into a late-cycle liquidity trap? Think about how these data points align with your own strategy. Thank you so much for joining me to unpack this fascinating moment in the markets. Keep questioning, keep learning, and I'll catch you in the next explainer.